You open your January statement from the retirement plan you have trusted for 20 years. The balance is still there. The line that is new is smaller than the logo in the corner. We have reduced the value of certain holdings in retail, dining, and service companies due to elevated risk of default and restructuring. Underneath, in brackets, sit names you know from errands and family dinners: Rite Aid, Red Lobster, Party City, WeWork, Big Lots. For the first time, the danger is not on the news. It is inside your savings. For decades you were told the same rule: big national brands are solid. These were not lottery tickets. These were the background of everyday American life. Then you learn that Rite Aid has been in and out of Chapter 11 since October 2023, weighed down by billions in debt and legal claims, closing hundreds of neighborhood pharmacies along the way. In practical terms, that means entire communities where the pharmacy on the corner is replaced by a dark box and a longer drive for blood pressure pills. When Red Lobster files for court protection in May 2024, after years of losses and heavy leases, it tells you something similar. Even a family seafood chain that once felt everywhere can no longer cover rent, wages, and borrowing costs at the same time. Then you see the wider pattern. Official court statistics, summarized at the start of 2025, show business bankruptcy filings jumping about 33.5% in the 12 months through September 2024 compared with the prior year. In plain English, where 3 sizable companies were falling before, now 4 do. That is not panic language. That is a hard count of firms that could not meet their promises once money became more expensive and customers more cautious. The question writes itself in your mind. If long familiar names are being marked down in pension accounts, what is happening underneath the surface of the whole system? On your list are 15 emblematic cases: Rite Aid, Joanne, Red Lobster, Party City, WeWork, Big Lots, The Container Store, 23andMe, AMC, Beyond Meat, Peloton, Wayfair, The Real Real, Rent the Runway, GameStop. Some have already filed, some are restructuring, some have warned investors directly. Together, they are not a set of random failures. They are one cast in the same financial story: heavy borrowing, costly locations, thin buffers, and a belief that big brands do not break. The uneasy truth, printed in that small note on your statement, is simple and cold. These 15 are not the whole problem. They are the early, visible sign of how easily we turned too familiar to fail into one bad year away from the edge in the era when borrowed money felt almost free. For almost a decade, we quietly built these companies a safety net out of cheap money. When rates were low and markets were forgiving, every big idea looked reasonable. Every lease looked manageable. Every buyout and expansion could be wrapped in the same promise: we will refinance later. It felt safe to hold pieces of names like AMC, Wayfair, Peloton, Beyond Meat, WeWork, GameStop in broad funds, because the cost of their mistakes was softened by the price of their loans. According to Federal Reserve records, from March 2020 until early 2022, the target federal funds rate sat close to zero, and by July 2023 it had been lifted to about 5.25–5.5%. In simple terms, a company that once borrowed at 2 to 3% now faces 8 to 10% or more when it rolls over risky debt. On $1 billion, that shift can turn interest from a manageable expense into a bill that eats nearly all operating profit. For chains with thin margins or declining sales, that is not a warning label. It is a countdown. The boom years blurred the risk. Peloton bikes sold faster than they could ship. Wayfair filled homes while people stayed inside. Beyond Meat looked like the future of protein. WeWork promised endless demand for shared offices. Easy funding let them grow first and test reality later. Some tapped debt to buy back stock or pay special investors. The bill for that confidence arrives only after demand normalizes and the coupon on every new dollar jumps. The same pattern touched older brands. Big Lots and The Container Store locked themselves into large footprints. Party City, Red Lobster, Joanne leaned on financing to get through disruptions. 23andMe and The Real Real raised capital on stories of transformation that depended on constant growth. Pension funds, index products, and retirement accounts for teachers, nurses, city workers all bought slices of this credit-fueled optimism without picking individual names. Ordinary savers became silent backers of balance sheets built on the hope that later would always be kinder. Now a wall approaches. Analysis from major debt trackers shows a surge of lower-rated corporate bonds coming due between 2025 and 2028, with high-yield maturities climbing steeply over that window. That means many of the same companies must soon replace old cheap obligations with new expensive ones. And this is where a simple question appears. What happens to a business earning only a few cents on each dollar of sales when refinancing its borrowings demands far more than that? The first clues were written in their own reports, long before most people thought to read the fine print. All it took to see the strain was to open the filings, not the ads. Annual reports, risk factors, footnotes. In that small print, many brands people shop with, eat at, or hold in their funds quietly admit they are near the edge. They speak plainly because the law demands it, and trust that few readers make it past page 80. Beyond Meat reports persistent losses and a balance sheet below zero, saying its future depends on cost cuts, new capital, and a rebound in demand. The Real Real and Rent the Runway describe reliance on credit lines and outside funding to stay liquid. If those doors close, they do not promise stability, they promise to evaluate alternatives. In everyday terms, without new lenders, continuation is a hope, not a guarantee. On the value end, Big Lots tells investors there is substantial doubt about its ability to keep operating as losses and planned closures mount. That phrase is not PR. Auditors allow it only when they see a real risk the bills will not be paid in full. For shoppers, it is the store for basics. For pension savers, it is a signal that part of the income behind their statements has turned uncertain. The modern darlings, The Real Real, Rent the Runway, 23andMe, file similar cautions. Ongoing losses, thin cash, dependence on a small circle of backers, exposure to any chill in spending or funding. Each writes some version of the same line. Survival depends on successful financing and better results that are not assured. Different logos, shared fragility. Some warnings arrived only after the damage. Party City and Rite Aid collapsed around communities that never saw bold advance alerts. WeWork's failure, after years of expansion, stands among the larger casualties of this period, built on long leases and borrowed optimism. AMC, GameStop, Wayfair, and others still trade, but their reports outline narrow cushions and heavy sensitivity to weaker discretionary dollars. Cornerstone Research counts 113 sizable companies with over $100 million in assets entering bankruptcy in a recent 12-month span, far above the long-run norm for giants. That one figure confirms what the small print has been whispering. The real question is not whether the signs existed, but why almost everyone treated them as background noise until the locks changed. The tear in the fabric shows up on an ordinary news day. One line from The Wire. Tupperware has entered Chapter 11, after warning it might run out of cash. Court filings list hundreds of millions in obligations and lenders trying to seize the brand itself. You grew up seeing those containers in every kitchen drawer. If a name that solid, selling plastic bowls, ends up in front of a bankruptcy judge, it is no longer about taste or trends. It is about a basic equation that stopped working. The next blows land close behind. Rite Aid's restructuring grinds through hundreds of pharmacy closures, and by 2025, reports show it's still fighting to survive, despite shedding locations and debt. Red Lobster's filing in May 2024 leads to shuttered dining rooms in coastal towns and suburbs that counted on those paychecks and tips. Party City's earlier collapse left empty storefronts where birthdays used to start. None of these stories say people stopped needing medicine, meals, or celebrations. They say long leases, thin margins, and expensive credit can break even very ordinary, very needed businesses. Zoom out, and the pattern hardens. S&P Global Market Intelligence counted nearly 700 U.S. corporate bankruptcies in 2024, the highest annual total since the aftermath of the Great Recession. A majority of those cases were attempts to reorganize rather than liquidate, which sounds reassuring until you translate it. Many firms hit the wall at the same time and are scrambling to rewrite their promises. For a saver or retiree, this indicator means more of the brand's inside index funds and bond portfolios are not gliding through a rough patch. They are formally asking courts for permission to keep breathing. Some of our cast side on different steps of the same staircase. The Container Store and Big Lots close locations and explore strategic options. AMC and GameStop trade on loyalty and volatility while carrying large obligations. Wayfair, Peloton, The Real, Rent the Runway chase profitability after years of losses. 23andMe cuts staff as cash runs down. None of these names is a punchline in this story. Together, they show how quickly growth stories and everyday chains can find themselves negotiating with landlords and lenders instead of customers. What makes this the moment everything snaps is not one famous logo in trouble. It is the realization that these events are clustered, driven by the same shift from easy debt to costly survival, and that every filing removes jobs, rent, and tax dollars from real places where people live. From here on, the question is no longer whether a handful of companies miscalculated. It is how their struggle cascades into household budgets, local services, and the value of the savings you thought were parked far away from this fight. You feel the impact long before anyone calls it systemic. Your town loses a pharmacy, then a craft store, then a casual restaurant where your grandchildren celebrated birthdays. The sign on the door always sounds temporary. Closing this location. Business decision. Visit us online. What it means in practice is that people who once worked 10 minutes from home now drive 40 minutes for a shift, or do not work at all. A place where you could fill a prescription, buy a card, and meet family for dinner turns into a dark strip that feels less safe after sunset. Follow the money, and it tightens around ordinary households. When a chain like Rite Aid shuts down locations, older residents drive farther for medications, spend more on gas, and have fewer options to compare prices. When Red Lobster cuts dozens of restaurants, hundreds of servers and kitchen staff lose steady schedules and tip income in communities that depended on seasonal crowds. Joanne or Big Lots downsizing means fewer low-cost choices for school supplies or basics. These closures are not abstract capacity reductions. They are small, permanent pay cuts on people's time, wages, and convenience. Local budgets absorb the next hit. Every lost store means less sales tax, empty square footage that drags down surrounding rents, and fewer workers paying income taxes in that jurisdiction. Mall anchors from our cast, whether it is a struggling big-box discounter, a home goods chain, or a specialty retailer, once funded pieces of school districts, road repairs, police overtime. When they vanish or shrink, cities do not send you a note blaming any single company. They simply freeze hiring, delay fixing intersections, trim library hours, or add small local fees that show up on utility bills. Meanwhile, the flow of failures accelerates. Data from S&P Global Market Intelligence show 371 corporate bankruptcy filings in the first half of 2025 alone, the heaviest mid-year pace in 15 years, and 446 by July. In clear terms, nearly every day, another sizable employer or landlord somewhere in the country admits it cannot keep promises under current costs. Many seek to reorganize, not close outright, but reorganizing usually includes closing weaker sites, cutting staff, and pushing creditors, and sometimes landlords and towns, to absorb part of the loss. For workers and savers over 60, the circle closes uncomfortably. These same brands sit in index funds in retirement accounts, in bond portfolios that finance local projects, in leases that underpin property values in their neighborhoods. When they cut back, you may lose a nearby job option, a trusted storefront, a bit of pension growth, and a piece of your town's tax base at the same time. It looks like scattered bad luck. It is, in fact, one chain. Overextended companies tightening, shifting strain onto households who pay more, travel farther, and get less in return. Seen from that angle, it stops being a story about logos and becomes a question no one really wants to ask. If this is what happens when a handful of overborrowed brands stumble, what does it mean for states and pension systems that quietly leaned on the same illusion of safety? When 15 household names start wobbling at once, the real issue is no longer whether you still like their products. It is how tightly your community, your savings, and your state budget are tied to the same fragile wiring. The logos are symptoms. The system is where the risk lives. Start with the states. After years of building cushions, new research from the Pew Charitable Trusts shows that by fiscal 2025, the typical state could fund operations from its rainy day account for about 46.9 days, down from 53.2 days a year earlier. In simple terms, the buffer has shrunk by roughly a week. When chains like Red Lobster, Big Lots, Rite Aid, or WeWork close sites or shrink payrolls, sales and property taxes in those locations thin out. With a smaller safety margin, governors and mayors respond the only way they can. They freeze hiring, postpone repairs, trim services. No alarms, no headlines about collapse, just a slow adjustment that residents feel in longer lines, rougher roads, fewer staffed windows. Next are pensions and long-term savings. A 2025 study from the National Institute on Retirement Security and Aon documents that public plans have shifted about 1/5 of their portfolios since 2001 from traditional stocks and bonds into private equity, real estate, hedge funds, and similar instruments. Those pools often hold debt and leases tied to the same brands and shopping centers now under pressure. For a retired teacher or city worker, this does not mean the check stops. It means more of the return that check depends on is linked to companies and properties that cannot easily handle today's borrowing costs. The risk that once sat out there on corporate balance sheets has been invited into retirement math. Then come the lenders. TREP's 2025 surveillance shows delinquent commercial mortgage-backed securities climbing above 7% before easing slightly, with stress concentrated in properties that depend on retail and office tenants. A global warning from the Financial Stability Board flags a $12 trillion commercial property market with elevated trouble in office and retail loans, and banks holding most of the exposure. Translate that. The buildings that house troubled brands, empty anchors, or downsized tenants are financed by loans sitting on the books of banks and funds that also serve your town and your pension. When too many of those loans sour, credit tightens first for small businesses and ordinary borrowers, not for the strongest giants. Put these layers together, and the pattern is blunt. Thin public cushions. Retirement systems more entangled with corporate and real estate bets. Credit markets showing rising strain in the same segments where familiar companies are cutting back. Going broke first in this world is not a televised collapse. It is a cycle of hiring freezes instead of layoffs, benefit trims instead of overt cuts, new fees instead of clear tax hikes, cautious banks instead of friendly ones. Households pay more for less, step by step, while official statements still talk about manageable conditions. The last turn in this story is not shouted. It is written in documents most people never see. Draft risk memos from major creditors and rating agencies already group companies like the 15 we followed into heightened concern lists for the next refinancing wave if rates stay firm and consumer debt does not ease. The public will hear about those names only when a filing hits the news or another anchor sign comes down. Until then, one question hangs over every pension statement, every local budget hearing, every half-empty center. In the next round, which of the brands your wallet quietly supports will still be there? And which will your own money help push over the edge?